Welcome to another Yubedo video. As you know, there are two main ways to profit in real estate. One is through the monthly operational income, which we often call cash flow, and the other is through long-term capital growth resulting from property value appreciation. In this video, we're zeroing in on operational income and breaking down how to calculate your cash flow. So without further ado, let's dive right in. The first thing you need to know is gross revenue. This is the money you expect to make from renting out the property. Let's say you plan to charge $2,500 per month in rent. That's your gross revenue. In reality, your property won't always be rented out. There might be months when it's vacant, so you need to account for that. If you expect a 5% vacancy rate, the amount you need to budget for vacancy will be $125 a month. This brings us to gross operating income. This is your rent after setting aside some money for those vacant months. By subtracting $125 from $2,500, we get $2,375 for our gross operating income. Now, owning a property isn't all about collecting rent. You have expenses too. These are called operating expenses. This includes money spent on repairs, maintenance, tax, insurance, and even a property manager. Let's say these add up to $500 per month. Once you subtract these expenses from your gross operating income, you get what's called net operating income. So, in our example, we would need to subtract $500 from $2,375, which equals $1,875. This is the money you actually make before paying off any loans. Speaking of loans, if you've taken a mortgage to buy the property, you'll have to make monthly payments. Let's say your mortgage payment is $1,200 per month. After paying the mortgage, what's left is your cash flow. So, subtracting $1,200 from $1,875 will leave us with $675. This is the money you put in your bank account each month. Now, let's talk about factors that can influence your cash flow. You can either hire an established company for repairs and maintenance, or find a local handyman to save costs. Managing the property yourself can save money, but hiring a professional has its benefits. On the mortgage side, a lower interest rate or a larger down payment can reduce your mortgage payments, improving your cash flow. Next, let's focus on improving your income. Make sure you're charging a fair market rent. Consider charging for parking or adding a laundry unit. A nicer property can attract tenants who are willing to pay more. If possible, adding a small secondary housing unit on your property can increase your income. Before we conclude, let's touch on an important point. The numbers we've discussed today are mainly for your first year as a property owner. As the years roll by, you can generally expect both your rent income and your expenses to rise, thanks to inflation. But here's the silver lining. Your rent, which starts at $2,500, is significantly higher than your initial monthly expenses of $500. So even if both increase at the same rate, the gap between them will widen. This means you'll have more money left over each month, boosting your cash flow in a way that compounds over time. And there you have it. These are the key metrics and strategies you need to understand to make a wise real estate investment. Remember, the goal is to improve your cash flow while considering long-term property value. Thank you for watching, and best of luck on your real estate journey.